Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey, everybody. Welcome back to the Get Real Podcast. Ron Phillips here. I promised you guys a look into the home ownership affordability monitor that's put out by the Atlanta Fed. I've been looking at this data. I did some other research and I just kind of wanted to go over this. If you guys Google this, we'll try to put a link in the show notes. But the Federal Reserve Bank of Atlanta does this home ownership affordability monitor, and it's really cool. When you first pull it up, there's a graph of the United States. They've been doing this since 2005. It looks like that's what the data shows. And I've mentioned this on the show before, but there's an affordability threshold line on this graph. So if you think about a bar chart, right, there's just a bunch of bars. Some of those bars are above and some of those bars are below. The bars that are above the affordability threshold is unaffordable. Okay. And we've had a few unaffordable times during the past 20 years that they've got on here. Okay. So in 2005, January of 2005, the share of median income was 39% to buy a house. Okay. Because the median price point was $207,000. Interest rate 5.7. Okay. This is in 2005, January of 2005. Now, median household income back then was $45,000. Okay. Now, those of you who lived through this time or who were in real estate at this time, owned property during this time, invested. In 2005, things were unaffordable. Again, share of median income to buy a house, 39%. Okay. Now, what are the levers that create unaffordability? Obviously, the price point of the house. If the price point of the house of the median home goes up, then things become less affordable. Okay. There's the median income. If the median income goes up, all things being equal, then it should become more affordable to own a home. Then there's the interest rate. If the interest rate declines, if the interest rate goes down, that is going to have an impact on the affordability. It's going to make things more affordable. Now, they're also including in here total payment, which includes taxes and insurance. Well, it includes principal taxes and insurance and PMI too. If for anybody who's familiar, mortgage insurance is for people who are putting less than 20% down on a property, specifically like FHA, like the loans that have very minimal money down. You have to pay mortgage insurance. That would be in here too. The reason I think they're including this into the home affordability is insurance has gone psychotic. Taxes have also gone crazy. And man, both of those things dramatically impact the affordability of homes. So we're going to talk about a lot of different things that affect affordability today. But it's important to note that our government is one of them, one of the biggest offenders, especially in certain markets. Also important to note that right now we're talking about national numbers. We're not talking about local numbers. And there's a big, big, big difference. Okay. So 2005, 39% share of median income. By 2006, which was July of 2006 was the most unaffordable time. Now, most people would think it would be like 2007, right before the crash, 2008. It actually wasn't. And there's a reason for this. Okay. Because it's important. The median home price is now $231, because remember it was $207. Okay. This is in 2005. So a year and a half later, price point is $231. Okay. but the interest rate has gone from 5.7 to 6.8. Okay, so that raise in interest rates really affected the affordability because now we're at 44%. So we went up 5 percentage points. It takes 5% more income, share of income to be able to afford a house. Then affordability actually starts to get better all the way through 2007 because prices are starting to come down. Remember, the builders had overbuilt. House prices start to come down. They trend down until they get to about the same as they were before. So about 205, I think we started at, let's just see, started at 207. By 2008, the price point was 205,000. But the interest rates had dropped back down to 5.9. So now we're at 34%. Started at 39, went up to 44, I think, and then we came back down to 34. So we're more affordable now than we were. And that's due to price point, but the price point's almost the same. Really what it's due to is interest rates came down. Okay. Now, when we get below the affordability threshold, when things become very affordable, as in January of 2009, price points now 183. Foreclosures have started to happen. Banks are dumping properties. Builders are losing properties. And interest rates are 5%. So interest rates have dropped. Okay. And then in 2009, same year, in 2009, we kind of go back up the affordability scale because the interest rates go back up. So the interest rate fluctuations that we're going to see over the next probably 20 years are going to play a massive role in how affordable homes are. In June of 2009, the median price point for a home is $179,000. Median income hasn't moved very much. It's $49,000. So right around 50. Okay. And we started at 45. So median income has only gone up just a little bit. Okay. Let's fast forward to the bottom of the market. You remember the bottom of the market was in 2012. So let's go to 2012. We're at the bottom of the market, which really, the home prices really only went down into the 170s. It really didn't go that far after we dropped to 185. It didn't really drop that much more nationally. But the interest rates dropped. Now we're at 4%, and we're at a 25% share of median income, which is really affordable, like really affordable, okay? And interest rates continue to drop, 3.4% at the end of 2012. Price points now rebounding to back to 186. This is the crazy thing. Interest rates are going to stay really, really low for the next forever here. And price points are going to steadily climb out of the chute, back up to median home prices being in the low twos. By 2015, we're at 225, and we kind of hover around there through 2016. 2017, we're up to 230. Now, that's the place where we were at kind of the top of the market. Interest rates still at 4%. Median income, though, is now 60,000. So we started at 45. We're now at 60. So incomes are climbing. We're still at 29% affordability, which is really good. And we go all the way to 2018, February of 2018. Home prices are 240,000, interest rates 4.3. And we start to see affordability start to climb above the line for the first time since 2009. And we're at so almost 10 years. And then in August of 2018, we start to see the first increases that put us above, firmly above affordability. Prices go to 253, interest rates go up to 4.6, income stagnant. Okay. Now, 2018, let's fast forward to 2020. Right. So I think that's right after COVID. Interest rates are 3.5%. Prices are 260. And we're still affordable now because interest rates dropped a point. Interest rates drop a point, guys. That's a big deal. Okay. So interest rates dropped, but prices started to go nuts. So pre-COVID, we were hovering around 240. Post-COVID, we get up to 286 in 2020. And then interest rates are 2.9. And at 2.9, and again, remember, everything is more expensive. We can't get anything in there. I remember when we were doing the internal construction on our house and we were ordering all of the things that we needed, you couldn't get hardly anything. Building costs are going through the roof. And we're going to see that hit because by early 2021, home prices are at 307. So first time we're above 300 in this whole, what are we at now? This whole 15, little over 15 years, 16 years period. Interest rates are still 3% though. So we're still at an affordable level in 2021. And then it looks like what I talked about before. It looks like Utah. When you fly in and the mountain is staring you in the face, right now we're about ready to go up the mountain. And this mountain by the following year, early 2022, sales prices are 354, not 355. Interest rates are 5.2. And it takes 39% of the median income, which is now 75,000. Okay. So it's pretty unaffordable. It's basically the same as it was in 2005. Exact same. But it gets worse. It gets worse because interest rates go up. Now, the price in June of 2022 is $360,000. Home prices drop a little bit. Again, and remember, this is median. I'm going to explain something about this here in just a second. They drop to 330. Interest rates rise to 6.3, and we're still at 39%. So the share of median income didn't change. The price point came down a little bit. Interest rates went up a little bit, and median household income went up a little bit. And the share of median income to buy a house is the same because there's all of these levers. This is a little bit more complex than people make it out to be. And I'm just going to fast forward. Let's just fast forward all the way to July of 2025. Okay. July of 2025, the share of median income to buy a house is 47%. Let that register for just a second. It's almost half of the median household income, which is now almost $80,000. Almost double what it was in 2005. But the house prices are double what they were. And the interest rate is 6.7%, which is not the highest that it's been, but really high still. And taxes and insurance are also far higher than they were. These are national numbers. So I got to thinking to myself, okay, those home prices went up in such a short period of time. I wonder what's going on in other local markets. So I chose a market. There's a really cool thing. You can do Metro View. So there's a national view and a Metro View. If you click on Metro View, you can select your metro. So I selected one that is reasonably inexpensive. Okay, so I went to Birmingham, Alabama. Birmingham, Alabama in 2005, 29% of the median share of income, super affordable. House price $152. Almost anybody can afford a house in Birmingham, Alabama. It goes up a little bit, not that much. It doesn't really ever get above the line that much. But there's some very interesting data on here. Okay, so home prices in Birmingham are affordable like pretty much the entire time until we get to 2022. Now, this is really, really interesting. The median home price in 2022 is $260,000. Okay. Interest rate 5.4%, and we're finally above the line on affordable. well, a little bit, right? So 30 is affordable, or 31% of median income. Okay. And then we've got these, it looks like a heart rate. We've got these spikes down, spike down, spike down, spike down. Okay. Now I'm going to go through these just for a second because this is fascinating to me. So we move forward a little bit. We spike up to 34%, but the median home price is 254. The median home price went down. Interest rates went up, and we got less affordable, which is a little bit bizarre. Okay. But then you go over to January of 2025. So the first part of this year, home price is 228. So $30,000 less. Interest rate 7%, and it's 30% of the median income. Now, this is the part that I find fascinating. So between January, we're talking about Birmingham, Alabama now, between January and June, home prices supposedly went up to $287,000, requiring 36% of the share of median income to buy a house. Now, that's fascinating to me because this happened in 6 months. We went from 228 to 286. 287. That's a pretty aggressive jump for the Midwest. It's a pretty aggressive jump for the Midwest. So I'm trying to figure out, like, what is not on this chart? What is it that I'm not being shown here? Because this is fascinating data. So I went and did some research on what is happening with the sales prices. Like, why are they kind of all over the place? Why are they up and down and up and down and up and down? Especially that kind of a jump in a place like Birmingham, Alabama, which doesn't really make a whole lot of sense to me. So I started to do some research, and what I found was pretty fascinating. I think all of us know that there are different tiers of markets, right? You got the affordable market, which we talk about a lot because there's just almost nothing affordable anymore. Unless you're in Birmingham, Alabama, of course, then it's affordable. But nationwide, it's really, really difficult. So my initial hypothesis was that there just must be an inordinate amount of luxury homes for sale, and that they're skewing the market. And that really didn't pan out entirely in the data that I was finding. Sales of homes priced above 1 million rose 35% year over year. So that market's pretty strong. The ultra luxury market is also really, really strong. Affordable market, like under $250,000 and under, is basically non-existent nationally. Okay. The builder affordability, why are there no affordable homes? Well, if you'll recall, we had Brian Mertz on. He talked a little bit about this, but building affordable homes doesn't make any financial sense anymore. And so there isn't as much inventory in that price band as we would have had in the past. It just doesn't exist. And incidentally, homes under 1,800 square feet are also in short supply, new construction. And then, of course, you have the compression of the people who have existing homes that aren't selling them that would be in that price band. And it creates a very low volume of sales. Not to mention the fact that the people who are shopping in that price band have less money, and it's more difficult for them to buy properties. A record 8.5% of homes in America are now valued at $1 million or more, which is up from a year ago. And those properties over $1 million made up 8.4% of all transactions in August. That particular market is really, really strong. And they're increasing in value. They're still going up in value because the sales are strong. Ultra luxury properties sit on the market a little bit longer, but they're also strong. And it's really interesting regionally because even in the Midwest, luxury homes are selling. And crazy places where luxury properties always sell really well, like Miami. West Palm Beach, Fort Lauderdale, those are not selling very fast. And they're not selling very well either. So sales of homes priced under $250,000 have dramatically fallen off of a cliff, while the north of $1 million have risen 35% year over year. Construction costs account for about it's almost 65% of the average price of a new home. Okay. That's 5% higher than it was in 2022. And the average profit margin is about 11% for builders. Okay. So on a $250,000 house where they're getting squeezed, it doesn't make much sense for them to build those properties because there's almost no profit in them. And that's if they can continue to get land that even works to build those properties at those prices. Less than 6% of the houses built in the state of Nevada in 2021 were entry-level homes. If there's no entry-level home, what do the people do? Well, they rent. They're forced to rent because they can't afford to buy the house. We have properties that are aging out of affordability, and those are properties that were like $150,000 back in the day. Now they're worth $300,000, so they're north of that. These are existing houses that are north of $250,000. I mean, that's a problem, and you can't build anymore. That's a problem, and there's not very many of those on the market. Is there demand destruction in that particular market? Has the demand been quashed? I don't think so. I think it's mostly there's not a whole lot of inventory for them to buy, and interest rates have certainly not helped them. But also the price point of homes is way too high. And almost all of the homes that are being built to replace any stock that isn't habitable is way higher than that price point in almost all markets across the country. Builders can't profitably build sub $300,000 homes because of construction costs and land costs and regulations. And you guys locally need to really consider the regulation piece when you're voting. Who is it that is putting these regulations in place? Are they really helping, or are they hurting the ability for people to live in these markets? So affordable inventory is vanishing, and it's forcing the buyers who would be in that particular market to either move to an economically distressed area, which means they're going to even have less money because the opportunities to make more money doesn't exist there, or they have to rent indefinitely right now because we don't know when any of this is going to shift, or they would have to stretch to buy above their means, which is really difficult to do because, again, this isn't 2005 where you could literally tell the bank any number you wanted, make it up of what you make on an annual basis. I mean, you can't do that anymore. They actually make you qualify for loans now. So that isn't going to work, right? Affordable homes literally don't exist in almost all the markets in the country. That's the reality of the situation. So where you have the ability to buy in those price bands, you should. That is what most of the large investment firms have been buying, by the way, because they know that, and you can't replace them. Builders have got pretty economically rational reasons to just not build these. The profit margins are too skinny. And especially right now where, the buying sentiment is not really there. And then existing affordable stock is also disappearing. There are about 53 million households that can only afford under $200,000 houses. If interest rates went back to where they were, that would change. But I don't think that's going to happen. I don't think interest rates are going to go back there. I think we've kind of mellowed out. Interest rates that we have right now in the mid to low sixes are historically still low, not crazy low, but they're historically still pretty low, and they're reasonable rates, in my opinion. This is a more than 1 decade structural failure of the ability to build homes that are actually affordable. And I would submit to you, caused by government overreach, government intervention in markets at almost every fathomable level of the market. That's my take on it. And I've talked at length about what they did with the banks back in the day that destroyed the housing market back then, elongated the crash, created this shortage of homes, especially shortage of affordable homes. And by eliminating the financial feasibility of building homes in a price band that was affordable, artificially keeping interest rates low. Every single time the government gets in and messes with the market, it messes the market up. And that's what they've done here. And that's why we don't have affordable homes. So those of you out there who are investing and you're able to buy units in that affordable band is really hard to find. It will become increasingly more difficult to find. I do not think we're going to have a crazy crash in interest rates. I don't think they're going to drop all that much. They might come down a little bit, but I don't think it's going to be enough to create any kind of crazy ability for people to buy in that lower price band. And what we have currently in the market is we have people who can afford to buy a house. And you can see that the above $1 million price point is still increasing. It's increased 35% year over year. And then you have a whole bunch of people who can't afford to buy a house. And that particular segment is collapsing. It's collapsing due to lack of inventory. And it's collapsing because people can't afford to buy those homes. However, they have to have a place to live. And that creates, just like it created last time, it creates a larger rental pool. We can like it, we can dislike it, but it is the reality. And that reality works for people who can buy and own assets. And so my suggestion is to buy and own assets. That would be my suggestion. And on that happy note, I'm sorry, that was a lot of data, a lot of numbers. It's hard to do that without being able to show you what I'm looking at. But I hope you got the main points. The affordable market is almost gone in America. And that's sad, but it's the truth right now. So until next time, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.